In May 2002, an internal auditor pulled up a general ledger account labelled prepaid capacity and could not reconcile what she saw. The figure was approximately $2 billion, booked as a capital asset, sitting against costs the company had already paid to other telephone carriers to carry its traffic. No one in the finance department could explain to her how an operating expense already paid had become an asset on the balance sheet. She began tracing the entries backward through the ledger, quarter by quarter, and what she found was not a single error, but a pattern. Line costs, the recurring fees WorldCom paid to lease network capacity, were being moved out of the expense column and into property, plant, and equipment. The question this episode answers is narrow and structural. How does a company take a cost it has already incurred, a cost that recurs every quarter, and make it disappear from the income statement without anyone in the audit chain noticing for more than a year? The answer is not complex accounting. It is one of the simplest frauds in the modern record, and that simplicity is precisely what makes it instructive. Let us begin with the mechanism, because the mechanism is the entire story. Line costs were WorldCom's single largest expense. To understand them, you have to understand what WorldCom actually was. It was a long-distance and data carrier that in many cases did not own the local connections that carried calls the final mile to a home or business. To complete a call or carry data, WorldCom paid other telecommunications companies for the use of their lines and their network capacity. These payments were called line costs or access charges, and they were the cost of goods sold for a telecommunications carrier. They were, in accounting terms, an operating expense. They were consumed in the period they were incurred. You paid for capacity in a quarter, you used that capacity in that quarter, and the cost belonged in that quarter's income statement. This is the baseline. Under generally accepted accounting principles, a cost that is consumed in the current period is an expense in the current period. It reduces operating income. It cannot be spread across future years because it produces no future benefit. The capacity WorldCom leased and used in the first quarter did not carry calls in the third quarter. It was gone. Now consider the alternative treatment: capital expenditure. When a company buys an asset that will generate revenue over multiple years, a building, a fiber optic network it owns, switching equipment, it does not expense the entire cost in the year of purchase. It capitalizes the cost, places it on the balance sheet as an asset, and depreciates it over the asset's useful life. A network built to last 20 years has its cost spread across 20 years of income statements. This is legitimate. This is how the matching principle works. You match the cost to the periods in which the asset produces revenue. The distinction between these two treatments is the line between truth and fraud at WorldCom. An expense hits earnings now. A capitalized cost hits earnings slowly, in small depreciation increments over many years. If you can move a recurring operating expense into the capital column, you accomplish two things at once. You remove the full cost from the current quarter's income statement, and you replace it with a tiny sliver of depreciation. The difference flows directly to operating income, and operating income, specifically a metric derived from it, was the number that mattered. That metric was EBITDA, earnings before interest, taxes, depreciation, and amortization. The telecommunications sector in the late 1990s and 2000 was valued on EBITDA and on the ratio of line costs to revenue. Analysts watched WorldCom's expense-to-revenue ratio as the single most important indicator of operational health. The record shows the company had publicly committed to maintaining that ratio at approximately 42%. When real line costs rose and revenue softened after the telecommunications market turned in 2000, that ratio came under pressure. Holding it at the promised level was no longer possible through operations. Here is the structural insight. EBITDA, by its own definition, excludes depreciation. So if you take a line cost and capitalize it, you do not merely defer the expense. You move it into a category that EBITDA ignores entirely. The capitalized line cost will eventually appear as depreciation in future years, but depreciation is the D in EBITDA. It is excluded by construction. So the capitalization of line costs does not just smooth the expense across time. It removes the expense from the headline metric permanently as far as EBITDA is concerned. $1 of line cost reclassified as capital expenditure is $1 that EBITDA will never see. This is why the fraud worked on the specific metric the market cared about. The reclassification was perfectly targeted. It moved cost from a line that depressed EBITDA to a line that EBITDA, by definition, does not include. The market valued the company on a number, and the fraud was engineered against precisely that number. That is the mechanism. A recurring operating expense, the largest the company had, was reclassified as a capital asset. Now we trace how it was built. The architecture had two distinct phases, and the SEC enforcement record and the subsequent bankruptcy examiner's reports distinguish them. The first phase used reserves. The second phase used the capitalization of line costs directly. They served the same purpose, to hold reported line costs down, but they drew on different sources. Begin with the reserve phase, because it came first and it sets up everything after. When companies make acquisitions, they establish reserves, also called accruals, for anticipated future liabilities and costs. WorldCom had grown through a long sequence of acquisitions, the largest being MCI in 1998. Each acquisition came with reserves. These reserves were liabilities on the balance sheet, money set aside against expected obligations. The record establishes that beginning in roughly 1999, when reported line costs threatened to exceed targets, the company released portions of these reserves to offset line cost expense. A reserve release reduces the reported expense in the period it is released. The expense was real. It was simply being papered over by drawing down a stockpile of accruals. Step 1 of the architecture then. When the expense-to-revenue ratio threatened to rise, accounting staff released reserves to reduce reported line costs. The record shows these releases were not always tied to the specific liabilities the reserves had been established for. Reserves established for one purpose were used to absorb general expense pressure. This is a misuse of the accrual mechanism. Reserves are meant to be released when the anticipated liability resolves, not when management needs to hit a quarterly target. But reserves are finite. A stockpile of accruals can only be drawn down so far before it is exhausted. By the second half of 2000 and into 2001, the record establishes the available reserves had been substantially depleted. The expense pressure had not gone away. The telecommunications market continued to weaken. Real line costs continued to consume more than 42% of revenue, and the reserve cupboard was nearly bare. The first mechanism had run out of fuel. This is the moment that produces the second mechanism, the one the internal auditor found in the prepaid capacity account. Step 2. Beginning in the first quarter of 2001, when reserves could no longer absorb the gap, the company began capitalizing line costs directly. According to the SEC's complaint and the findings that followed, the controller's organization transferred line cost amounts out of operating expense accounts and into capital expenditure accounts, specifically into property, plant and equipment, under categories including the one labeled prepaid capacity. These were costs the company had already incurred and paid. They were recharacterized after the fact as capital investments. The sequence within a quarter, as the record reconstructs it, ran roughly as follows. The books would close at the end of a quarter on an operational basis, reflecting actual line costs. The expense to revenue ratio would come in above target. Senior accounting personnel would then determine the dollar amount of line cost that needed to be removed to bring the ratio into line. Journal entries would be made after the operational close, transferring that amount from line cost expense to capital accounts. The entries were made at a high level in the general ledger, not at the level of individual invoices or transactions. There was no underlying analysis tying specific costs to specific assets. The amount was determined by what was needed to hit the number, and the entry was made to produce that number. This is the structural signature of the fraud, and it is worth stating plainly. In a legitimate capitalization, the amount is determined by the cost of an actual asset, and the accounting follows the economic event. At WorldCom, the causality ran backward. The target determined the amount, and the accounting entry was constructed to reach the target. The asset did not exist. The journal entry created the appearance of an asset to absorb an expense that needed to disappear. The figures, as the record establishes them, are large. The SEC's filings and the company's own restatement identified line cost transfers to capital accounts totaling, across the relevant quarters, several billion dollars. The internal auditor's initial discovery centered on a figure of roughly $2 billion in the prepaid capacity account. The full restatement, when it came, was far larger, encompassing both the reserve releases and the capitalized line costs and other items, and the cumulative overstatement of pre-tax income reached approximately $11 billion across the relevant period. Consider what each transfer accomplished mechanically. Take a quarter in which $1 billion of line cost was transferred to capital. That $1 billion left the income statement as expense. In its place appeared at most a small amount of depreciation, because property, plant and equipment of this type was depreciated over many years. So $1 billion of expense was replaced by perhaps a few tens of millions of depreciation in that quarter. Pre-tax income rose by nearly the full billion. EBITDA rose by the full billion, because EBITDA excludes the depreciation entirely, and the balance sheet grew, because $1 billion of new assets had appeared. That last point matters for detection, and we will return to it. A company that capitalizes its operating expenses will show capital expenditure rising. Its asset base will balloon. Its reported profitability will look strong precisely while its cash generation does not improve, because the cash went out the door as line cost payments regardless of how the payments were booked. The fraud improved every accrual-based metric while doing nothing for cash. The divergence between reported earnings and cash flow is, in principle, observable. We will examine why it was not observed. The architecture, then, reduces to a simple two-stage structure. Stage 1. Deplete acquisition reserves to offset line costs until the reserves run out. Stage 2. Capitalize line costs directly into property, plant and equipment to continue holding the expense ratio at target. Both stages served one number, the expense to revenue ratio, and through it, EBITDA and reported earnings. There were no exotic instruments. There were no offshore special purpose entities of the kind that characterized other frauds of the era. There was a journal entry made after the close, moving a number from one column to another. The simplicity is the point. Now we turn to detection, and the question that organizes this section. Given that the mechanism was this simple, why did it persist for more than a year across multiple quarterly reporting cycles and an annual audit? Begin with the external auditor. The company's financial statements were audited by Arthur Andersen, the same firm whose role at Enron was unfolding in the same period. The audit was supposed to provide independent verification that the financial statements fairly presented the company's position under generally accepted accounting principles. The capitalization of line costs was a clear departure from those principles. So, how did it survive the audit? The structural answer lies in how the audit was scoped and what information the auditor was given access to. The record, including subsequent investigation and testimony, indicates that the entries reclassifying line costs were made at a high summary level in the general ledger, in topside journal entries that did not flow up from individual transactions. An audit does not re-examine every transaction. It tests samples and relies on analytical procedures and on the representations of management. Topside entries made after the operational close at the corporate level are exactly the entries least likely to be caught by transaction-level sampling because they do not correspond to any transaction. They exist only at the summary level. There's a further structural feature. The internal accounting function was organized in a way that limited the visibility any single person had into the full picture. The record describes a separation between the general accounting group, which made the high-level entries, and other parts of the organization. Personnel who questioned entries were, according to subsequent testimony, given limited explanations or directed to proceed. The information needed to assemble the full picture was distributed across the organization in a way that no single gatekeeper held all of it. Consider also what the external auditor was relying on. An auditor relies substantially on management representations and on the internal control environment. If management asserts that certain costs represent capitalizable assets, and the control environment does not independently flag the assertion, the auditor's verification depends on the auditor's own skepticism and on access to the underlying detail. The record indicates the auditor was not provided certain detailed ledgers and was, in some instances, given access that did not surface the top-side entries directly. The verification chain depended on access that was not fully granted. Now consider the analysts and the rating agencies. Equity analysts covered WorldCom intensively, and the company was a major issuer of debt rated by the agencies. They had the public financial statements. Could they have detected the fraud from the outside? In principle, the divergence we identified earlier was visible in the public filings. Capital expenditure was high. The asset base was growing. And critically, operating cash flow was not improving in the way that strong reported earnings would suggest. When a company capitalizes operating costs, reported earnings improve, but cash generation does not because the cash still leaves the business. The ratio of capital expenditure to revenue and the gap between reported EBITDA and actual cash flow are quantities an analyst can compute from public data. But here the structural problem is one of interpretation, not availability. WorldCom was a company that had grown explosively through acquisition and that operated in a sector then characterized by enormous network build-out. High capital expenditure was the expected condition of a telecommunications carrier building fiber and capacity for anticipated internet traffic growth. A rising capital expenditure figure did not look anomalous against the backdrop of an industry investing heavily in infrastructure. The fraud hid in a category that the market expected to be large and growing. Had WorldCom been a low capital intensity business, a sudden surge in capitalized costs would have been conspicuous. As a network carrier, the surge was camouflaged by legitimate expectations about the business. This is the general structural lesson about detection in this case. The fraud was hidden not in complexity, but in plausibility. Every individual fact, the high capital expenditure, the strong EBITDA, the maintained expense ratio, was consistent with the story the market already believed about the company and the sector. Detection would have required someone to disbelieve the plausible story and to reconcile reported earnings against cash generation with sufficient skepticism to ask why the two diverged. Outside analysts had the data but not the access to the ledger entries that would have proven the divergence was fraud rather than aggressive but defensible accounting. What would have had to be true for earlier detection? The internal control environment would have had to include a check that prevented topside journal entries from reclassifying expenses without supporting documentation tying the entry to an actual asset. The audit would have had to scope specifically for topside entries at the corporate level and demand the underlying detail, and an outside party would have had to treat the divergence between earnings and cash flow not as a question to be answered by management's narrative, but as a red flag to be independently resolved. None of these checks operated in time. The detection that did occur came from inside, and it came through a path the architecture had not anticipated. The internal audit function reported, in the structure that ultimately mattered, to the audit committee of the board rather than solely to management. This reporting line is the single structural feature that made detection possible. Now, the unraveling. The internal audit department at WorldCom had been examining capital expenditures, initially in the context of an operational review rather than a fraud investigation. The record establishes that internal auditors began questioning the capital accounts in early 2002. As they traced entries, they encountered the prepaid capacity figures that could not be substantiated by any underlying analysis. When internal audit asked operational and financial personnel to explain the basis for capitalizing these line costs, no satisfactory explanation was provided that tied the amounts to actual capital assets. The work proceeded outside the normal channels. The record and subsequent accounts indicate the internal audit team conducted significant portions of their analysis after hours, accessing the general ledger system to trace the entries themselves rather than relying on explanations from the accounting group. They reconstructed, from the ledger, the pattern of transfers from line cost expense to capital accounts. They quantified the amounts. They established that the entries lacked supporting documentation and did not correspond to capital assets. The critical structural moment came when the internal audit function escalated to the audit committee of the board of directors rather than resolving the matter within management. the internal auditor brought the findings to the chairman of the audit committee. The external auditor, by this point Arthur Anderson's successor on the engagement, was brought in. The controller was asked to provide the accounting justification for the capitalization. The record establishes that no justification consistent with generally accepted accounting principles existed because the costs were operating expenses that had been reclassified to hit targets. The sequence then moved quickly. In June 2002, WorldCom publicly announced that it would restate its financial statements, disclosing that line costs had been improperly capitalized in amounts that, at the initial disclosure, totaled approximately $3.8 billion. The figure grew as the investigation deepened. The chief financial officer was terminated and the controller resigned. The Securities and Exchange Commission filed a civil enforcement action against the company within a day of the announcement, charging that WorldCom had violated the anti-fraud and reporting provisions of the federal securities laws by overstating its income. The collapse of the fraud mechanism was immediate once exposed, because the mechanism depended entirely on concealment of a single fact: that operating expenses had been recorded as assets. The moment that fact was established, the restatement was unavoidable. There was no defense available, no aggressive but defensible interpretation to retreat to, because the costs were unambiguously operating expenses. The asset entries had no economic substance to point to. Reversing the fraud meant moving the costs back to the income statement, which is what the restatement did, and the restated income statements showed losses where profits had been reported. The financial consequences cascaded. The restatement destroyed the company's reported profitability and revealed that the balance sheet was inflated by the fictitious assets. WorldCom filed for bankruptcy in July 2002, in what was at that time the largest bankruptcy filing in United States history. A bankruptcy court examiner was appointed and produced detailed reports reconstructing the accounting. The examiner's investigation expanded the scope of the misstatements, ultimately identifying overstatements of income through the line cost capitalization, the reserve releases, and additional items that aggregated to approximately $11 billion. The criminal proceedings followed the civil enforcement. The chief executive, Bernard Ebbers, was indicted on charges including securities fraud and conspiracy. The record shows that in 2005, a federal jury found him guilty on the charges, and he was sentenced to 25 years imprisonment. The chief financial officer pleaded guilty and cooperated with the prosecution, and his testimony at trial established elements of how the entries were directed and made. Other accounting personnel pleaded guilty. The convictions establish, as a matter of the legal record, that the reclassification of line costs was a knowing fraud rather than an accounting disagreement. The SEC's enforcement action against the company was resolved through a judgment that imposed a civil penalty and required reforms to the company's governance and internal controls. The company, reorganized under the name MCI, emerged from bankruptcy and was subsequently acquired. Arthur Anderson, the auditor, had by this point effectively collapsed in connection with the Enron matter, and the WorldCom failure contributed to the broader reassessment of the audit profession that was underway. Now, the structural findings. This case establishes several things about the mechanism, and they are worth stating as findings rather than as lessons. First, the WorldCom fraud demonstrates that the most consequential accounting frauds do not require complex instruments. The entire mechanism reduces to the misclassification of a recurring operating expense as a capital asset. There were no derivatives, no off-balance sheet entities, no structured transactions. There was a journal entry. The simplicity meant the fraud was enormous in dollar terms, while requiring very few people to execute, because a topside entry at the corporate level moves billions with a single keystroke. The scale of a fraud is not proportional to its complexity. A simple mechanism applied at a high enough level in the ledger produces the largest distortions. Second, the case establishes the specific vulnerability of metrics that exclude categories of cost by construction. EBITDA excludes depreciation by definition. The fraud exploited this precisely by moving cost into the excluded category. A metric designed to strip out the effects of capital structure and investment becomes, in the presence of misclassification, a metric that rewards the conversion of expenses into capital. The reliance of the telecommunications sector on EBITDA created the precise incentive structure that the fraud satisfied. Where the market values a company on a metric that ignores a category, there is a structural pressure to move costs into that category. Third, the case establishes the importance of the reporting line for internal audit. The fraud was detected because the internal audit function had a path to the audit committee that did not run through the management responsible for the fraud. Detection did not come from the external auditor, the analysts, or the rating agencies. It came from inside, from auditors who traced the entries through the ledger and escalated past management to the board. Had internal audit reported solely to the executives directing the entries, the path to detection would not have existed. These structural features produced direct regulatory consequences. The WorldCom failure, arriving in close succession with Enron, was a principal cause of the Sarbanes-Oxley Act of 2002. That statute requires the chief executive and chief financial officer to certify the financial statements personally, attaching individual accountability to the numbers. It requires management to assess and report on the effectiveness of internal control over financial reporting, with the external auditor attesting to that assessment, a provision aimed directly at the kind of control failure that permitted topside entries without support. It strengthened the independence and authority of audit committees, formalizing the reporting line that proved decisive at WorldCom. And it created the Public Company Accounting Oversight Board to regulate the audit profession, replacing the self-regulation that had governed firms like Arthur Andersen. The forensic finding is this: WorldCom did not fail because of a sophisticated deception. It failed because a simple reclassification applied at the summary level of the general ledger and targeted at the precise metric the market valued could move billions out of the income statement before the verification chain caught it. The mechanism was a journal entry. The control that should have stopped it did not require documentation for topside entries. The metric that should have revealed it excluded the affected category by definition, and the gatekeepers who should have detected it lacked either the access or the skepticism to reconcile reported earnings against the cash that did not follow. The fraud ended when an auditor inside the company traced the entries herself and escalated to a board committee that management did not control. That is where the verification chain finally held. The record is closed. The findings are these.